All right. Welcome back to the Financial Breakaway podcast, your clear path to retirement. I'm your host, Ryan Hitchcock, and I'm a financial planner with High Point Capital Group out of Milwaukee, Wisconsin. And it's always my goal of this podcast to empower individuals like yourself to help make confident decisions for a secure retirement. Now, today I have an amazing guest, Bryce Gill, an economist from First Trust. We had this conversation, I believe, last year at this time, Bryce, and so I'm happy to have you back. We're looking forward to hearing your thoughts on just like a review of the equity and bond market and the economy from this year, 2023. And then, since we're at the end of December, what your thoughts are moving into 2024 on just that, the markets and the economy. So again, thank you for being here. Bryce, maybe I'll let you introduce yourself and then we'll jump into it.
All right. Well, hey, Ryan, great to be with you again as we sort of wrap up another year, another kind of crazy year in the financial markets. Pleasure to be with you. My name is Bryce Gill. I'm an economist at First Trust Portfolios. So we are a privately held asset manager. We are the ones that put together, exchange traded funds, closed end funds, unit investment trusts. We work pretty much exclusively with financial advisors like Ryan. And my role at the company is I work on the economics team. So when we have clients that use our products and they get access to the resources that we provide, and I'm one of those resources. We do a lot of original research. I travel around the country, do public speaking events for professionals in the financial markets, but also normal people as well. I interface a lot with the media, the public, through things like this, like podcasts.
And you guys have had some of the nationally ranked, however they rank, economist teams, some of the best economist teams for the last handful of years, from what I see. Correct?
Yeah. So Bloomberg, we're typically one of the top 5 forecasters on Bloomberg. They go ahead and look at our forecast versus the consensus or other economic forecasters across the country. That's sort of how they rank things. And then we're really proud in 2022. A group called Consensus Economics, which does a similar thing. They actually ranked us the #1 forecaster in the United States. And the big reason why was because of our outlook on inflation. We were one of the early groups to say, hey, this time's going to be different.
Yeah, you guys were calling that earlier last year. So, well, congratulations on that. And also congratulations on that amazing mustache. That thing is amazing.
Well, thank you. Yeah, this is about 1.5 years of growth here. So I appreciate that.
That's good. Well, cool. Well, let's jump into it. So you said this in your intro, 2023. It's been a wild ride this year, and the market's kind of surprisingly good, though, right? What's going on
absolutely.
there? What happened?
Yeah, so hey, last year was kind of characterized by this big surge in inflation that surprised everybody, and really the Fed response, right? That was kind of the big driver.
Transitory.
Yeah, inflation was not transitory. Hiked rates at the fastest pace since Paul Volcker. Anytime interest rates go up, it's going to affect financial asset values, right? And so, hey, we saw a big correction in the market last year, mostly driven by high multiple tech and growth names. And then this year's sort of been an exact mirror image of that, where, hey, that headline inflation rate has fallen pretty rapidly, and I'm sure we'll get into the reasons why. That's led to a lot of optimism, especially here over the past couple of months, coming out of the Federal Reserve, saying, hey, basically, looks like inflation's been conquered. They basically declared mission accomplished, said we're done hiking rates. And now if you look at the forecast, actually, we're expecting rate cuts before we see any more rate increases, right? So,
and to be clear, that was just last week, right? Like last week, the Fed came out and kind of made this change, if you will, correct? Just to be clear to our listeners. Yeah, that cool. Okay, well, expand on that. That was a big change, right?
Yeah, exactly right. So, hey, they've essentially been saying, listen, don't get too excited. There's still a lot of challenges out there. There's still a lot of challenges ahead. We could still have more rate hikes on the horizon. Higher for longer has sort of been, I guess, like the narrative all year. Whereas like last year was transitory inflation, then it was higher for longer. Now they're stepping away from that and saying, hey, we might have rate cuts here on the horizon. Fed governors have been coming out and saying, listen, we're not willing to keep interest rates high permanently, especially when we see the unemployment rate start to tick up. So they've sort of shifted in a more dovish direction. That's what we use in industry.
Well, that's good.
More concerned about unemployment. Hawkish is more concerned about inflation.
So, all right. So that'll be a good, maybe we'll jump back into that for like the 2024 conversation. So this year, there's a lot of talk of the Magnificent Seven driven by AI. What was your take on all that with just the equity market?
Yeah. So, obviously AI became another sort of buzzword this year. Companies coming out saying, listen, this is the new, like the fourth industrial revolution, right?
Sure.
Like technology is going to start moving so rapidly and we all need to get on board. And, this has driven, I think, a certain sector of the markets, right? Tech
Yeah.
growth and I do think AI is part of this, but I think the bigger thing that's going on here is twofold. One is interest rates, kind of the change in the perspective on inflation, the fact we might have rate cuts going forward. That's going to disproportionately benefit high multiple growth type names. And then the other side of it is there's been a widespread kind of consensus or expectation of a recession here on the horizon.
Okay.
And so in the past, what you do is you pile into like AT&T or you pile into like these really safe blue chip stocks. Well, there's sort of like an argument today that the blue chip safe stocks to be in are the big tech
The
companies.
big tech
Right?
companies.
Yeah,
Yeah.
like Apple has $250 billion in cash. Like, how can anything really go that wrong for them?
That's
And so I've
crazy.
seen it's sort of like a safety trade. Pile into tech, waiting for this recession, which just hasn't materialized yet. And then ultimately, hey, maybe we see a rotation out of these names into small caps or the broader market. But that's why I think we've seen this really narrow sector of the markets outperform. And by a lot of different measures, right, this looks like the tech bubble of 2000. So seven stocks, their outperformance versus the broad market versus like small caps, right?
Yeah.
It's giving sort of bubbly, I guess, feelings,
Sure.
at least if you look at like valuations.
So like coming into this year, so 2023, you mentioned that there was a lot of talk of recession. So would you say that simply because of these seven Magnificent Seven AI stocks that didn't materialize, or was
No,
there more going on?
I think it's important, right, to distinguish Main Street, which is like the real economy, the unemployment rate,
Okay.
people's
Yep.
wage growth, versus Wall Street, which would be like, yeah, these seven stocks that have done so well.
Okay. Yeah.
Um, you know, I think the big surprise, at least from like the real economy, has been how strong the labor market is remaining, right? So we're still at roughly a 50, 60-year low in unemployment. I think a big part of this, by the way, has been all the shifts in supply chains that we've seen after COVID. So we've gone from basically the status quo being globalization, use cheap labor abroad, have these really elaborate, efficient supply chains all over the world to now, hey, let's reshore, let's bring back these critical industries. The United States government is actually explicitly subsidizing this with huge federal legislation like the CHIPS Act, like the
Chips
Inflation
Act.
Reduction
Yeah.
Act. And then on top of that, it's just that, and this is maybe another reason why AI has kind of been so in vogue lately, is just the realities of demographics. Okay, so for like 30 years, we've used cheap labor all over the world to make everything. The cheap labor is drying up, right? Like China's population has peaked, Vietnam population has
Yeah.
peaked, South Korea, like go down the list. And so that's another reason why I think we're going to see a long-term secular trend in bringing certain business back to the United States. But the reality is, hey, that's going to be short-term inflationary, right? And then on top of that, hey, how do we replace all this labor that's disappearing? Well, you do it by boosting productivity of the people that are still working, right? I think that's essentially the promise that AI is making.
Interesting. Well, that's good. So tie that into the bond market then this year too. I mean, since we're talking a lot of equities, stocks, a handful of stocks, but the market, stock market was crushing it this year. But the bond market had a little bit tougher time, wouldn't you say, or up until maybe 2 months ago?
Yeah, I think so for normal people, right? They see Nvidia do really well, or like last year was all about these meme stocks like Bed
Yeah,
Bath and Beyond, or
sure.
AMC, right?
Yeah.
I think what's really the most interesting to me is the volatility in the bond market, right? So we all look at the 10-year treasury yield in the finance industry, sort of like the benchmark interest rate.
Yep.
That's been trading like a meme stock, right? Like it's been bouncing all over the place. And so being the most important price in the financial markets, this has caused all kinds of volatility and kind of uncertainty. And so I think what's really important to communicate to people is listen, after 08, 09, the Federal Reserve stepped in unprecedented ways. They're printing money. They're doing quantitative easing, right? Trillions of dollars. But
Yep.
big picture, what they're doing with all that money is they were buying government bonds. Okay. So they buy all at the short end, but if they're committing to doing it for the indefinite future, right, it starts to affect long-term bond yields as well. And that's what was happening. The Fed essentially was manipulating the entire yield curve.
Sure.
Okay. And
Yeah.
so now what's happened is, hey, they helped spark off the worst inflation in 40 years. Not only are they not buying, they're actually, net sellers, right? They're letting their balance sheet roll off.
Yep.
And so we used to call it like the Fed put, essentially like, hey, if something bad happens in the markets or the economy, the Fed's going to step in and just
Buy them up.
shoot money at the
Yep.
problem, right? And that's no longer going to be the status quo, right? They can't, because they just caused the worst inflation in 40 years. They're worried about re-sparking that inflation. So the Fed, as the biggest buyer of government bonds, has fully stepped away. Now, at the short end of the curve, they still sort of control that. But now longer out on the curve, everyone's sort of wondering, hey, how involved is the Fed going to be? Can they even be involved at all? And what you've now seen is market-based forces reasserting themselves at the long end of the yield curve for the first time. So we used to call these bond vigilantes in the 1980s.
Interesting.
And that's why you're seeing extreme volatility in interest rates. And
so
everybody's sort of very excited about interest rates plummeting by like a full percentage point in the past month or two, right? Which, again, that doesn't sound like a lot, 1 percentage point, but it's huge movement
in the bond. Yeah.
In the bond market.
Yeah.
And my caution to people would be, listen, interest rates shot up from like 3.5 to 5. Now they've fallen back to like 4. They could shoot back up to 5 again. I mean, that can easily happen. I think it's market-based forces driving things here, not so much just like, hey, we fully defeated inflation. I think there's a lot of trouble underneath the surface there that's going to be challenging to deal with.
No, that's good. So if I kind of recap that maybe in, like my head, not the economist, smarter head like yourself, but like when we're talking short end, and even for our listeners, like trying to talk to retired people, we'll maybe sum it up for what they should think about, when looking at economies and, the returns in the market year to year. But what you're talking about, like short end of the yield curve and long ends of the yield curve. So maybe just dumb that down a little bit for us and say, what is the short end? Just, in our world, what does that mean? And what are you relating to?
Yeah. So the yield curve, essentially what we're talking about is a certain like amount of maturities, like so the length of time you're lending. So short end of the yield curve, like you lend to the government for 3 months, right? And you get a certain annualized return. Then you could lend to the government for a year. You could lend to them for 5 years. You could lend to them for 10 years, for 30 years, right? So that the interest rate on each one of those maturities, that's the yield curve. Right.
Yeah, and traditionally, the shorter amount of time you lent, the lower return, and then the longer term you let them lend money, the bigger the return. But essentially, that flipped this year, right?
Yep, and that's exactly what I was going to get into. Is there's a risk premium inherent in lending for a longer period of time, right? Just because, hey, I'm more uncertain about what's happening 10 years from now than what's happening 3 months from now. So typically, we as investors require a higher interest rate for that uncertainty, a risk premium, a duration premium, right?
Yeah.
And so what's happened is the yield curve has inverted. Basically, the short end of the yield curve, where you're lending for a less length of time, you're earning a higher interest rate than the long end of the yield curve. And the only reason that really happens is leading into a recession. There's a whole bunch of different theories about why that is, but the easiest to describe is basically, hey, we're expecting rate cuts in the future. Right. And so why would rate cuts happen? Well, the Fed typically cuts rates because of recessions on the
horizon. Yeah, that's a good point. And we were talking about this just before we started recording, but there's a difference between the market, the ups and downs of the market, and the economy. And a lot of times they don't match up. And so you're talking about what's interesting right now. I know we're kind of jumping back from 2023, but even moving into 2024 a little bit is or potential is that, when they're dropping interest rates, what you're kind of saying, it's kind of euphoric on the market right now. It's seen as a good thing, but they're doing that for the economy, maybe not looking as good in the future. Am I right in kind of explaining that simply?
Yeah. And, you think about it. So the Fed has what's called the dual mandate. They care about employment and then they care about inflation. And they sort of want to like balance these two.
Yep.
And so, hey, if the economy was going to be so great, if unemployment's going to be at like a 50-year low next year, and inflation was continuing, like, why cut rates? There'd be no reason to really do it. You might as well just wring it all out of the system. And so the market's pricing like 6 rate cuts next year. The only reason that really would make sense is if we were expecting a slowdown in the economy. And I want to be clear and say, like, I'm not expecting 0809 to happen again, or like COVID-19. And as Americans, we have a lot of recency bias when we think about recessions, just because the last two we've had have been historically really very bad, right, from almost every metric.
Yeah.
I don't think that's what we're really looking at next year. I mean, I think we're looking at a pretty minor recession. I think, again, 2000, the tech bubble is kind of a good example. We did have a recession post tech bubble, but it was mostly just in like corporate earnings, right? It wasn't really on Main Street. There wasn't a huge increase in the unemployment rate. That's where I think we're kind of at next year as well.
Like a muted recession in certain sectors of maybe some bigger corporate profits. Okay. That makes sense. So let's talk about that. So like moving into 2024, maybe just, expand on that. With potentially a recession coming is what you guys at First Trust is potentially seeing. What does that mean for, the markets, and maybe even relate that to, like this podcast is towards the retired, close to retirement, near retirement, at retirement type of, individual or couple?
Yeah. So why do we care about recessions as investors? I mean, the big reason why is profits, right? So typically, if a recession happens, what's going to occur is unemployment will go up, broadly speaking. If people have fewer jobs, or you're going to get less of a wage increase because generally, like, the economy is sort of under pressure, that's going to translate into slower consumer spending, right? And so if companies' revenues are going up more slowly, then it's also going to obviously affect their profit growth, or you could see even profits contract. And so that's why we really care about recessions as investors, is it affects earnings. And earnings and interest rates are the two biggest variables that go into financial asset valuation. So,
and that's what makes the market go up and down. Okay.
Exactly.
Yeah, well, explain that well. Yep.
Ideally, right, what you see in a recession is, hey, earnings go down, but the Federal Reserve has stepped in. They're cutting rates to sort of help stimulate things, right? Keep things from being really bad. The problem this time around, and that's what they've done after 0809 for the past like 15, 20 years before the pandemic, they just cut rates to zero. Well, what I'm saying is, hey, inflation's just going to still be above their 2% target. So even if we have a recession, they can't do that anymore,
Sure.
right? So then you're going to have falling earnings and not that big of a decline in profits that can offset, or in interest rates that can offset it. We might have even seen like the whole decrease in interest rates already get priced in as we head into next year. And so you could have a kind of a bad combination where you have unemployment go up, earnings are under pressure, and then interest rates can't really fall much more.
Okay. So let me play devil's advocate kind of to that. And, like consumer spending. So like this year, the consumer actually was very resilient. They went out and spent, they were traveling. Do you see that maybe playing out next year as well to kind of prop up, or almost mitigate this recession potential?
Yeah. So, again, I don't think we're going to have a cataclysmic recession, but there's a couple of things that are starting to look more late cycle with consumer spending. So, you look at like credit card balances; those are starting to get maxed out. Default rates on credit cards are starting to rise. People, I think this past year, what's basically happened is people spent less on goods, right? I'm not going to Home Depot 3 times a week anymore.
Yeah.
I've been going out to eat more, though. Well, that activity in like the service sector has kept the economy, broadly speaking, growing, whereas goods have been sort of contractionary. Well, now services have fully recovered, and people can't keep getting more haircuts and going on more cruises and getting on more airplane flights anymore.
Sure.
And so I think the biggest driver, the service sector, is sort of running out of gas. At the same time, you're seeing people's credit cards getting maxed out. You're seeing bankruptcies start to rise. So there's certain indicators that we'll look at that typically forecast recessions pretty well. What I will say, and sort of the asterisk I'll give here, is all these traditional measures have gotten less useful in the past few years. Why is that? Because we shut down the entire economy worldwide and printed trillions of dollars for this pandemic, and this has just never been done before. And this has affected economic indicators in an unprecedented way. And so I don't want to say we're flying blind here, but it does make forecasting more difficult, and there's a wider band of error, like no
Yeah,
question.
that's a good point. I was just thinking about that. It's like how I've been kind of talking about it is it's almost like the, shutdown or COVID hangover of the economy, because it's just been whipsawing back and forth. Like it's feeling good in certain spots and then it'll move into a different spot. Like you were explaining with people going to Home Depot and fixing up their house, then that changed to now they're traveling, going out to dinner and all that. So just going like this. But that means potentially next year, or the further we get out from that, things should get back to more normal, correct?
Yeah, and I'm not really a pessimist at all. I think the U.S. economy is going to be fine, generally speaking. I think we're going to have some bumps along the way. It's really more that I'm the uncertainty, the volatility in markets. I think is going to
Yeah.
be sort of a fact of life. And so that doesn't mean you have to be pessimistic. That doesn't mean you have to think the world's going to end or you need to buy a bunch of canned food or anything like that, right? But I think that there's implications to the new volatility that we're seeing uh, with regards to like portfolio management. I think we should do some things to sort of tamp down on that volatility. I think the past 2 years is kind of a good example of this, right? Like last year, stock market, generally speaking, fell, but like lower volatility, kind of like value type stocks were
Did
flat, up
Yeah.
like 2%, right?
Yeah.
Year. Well, hey, the market's way up, but those low volatility things have basically not moved either. So you can either ride like this roller coaster, ups and downs with like seven big names. One year you're down 40%, the next year you're up 40%, or you could kind of just be in more boring investments or sort of tilt towards that direction and reduce the amount of volatility you're being exposed to. And that's sort of the argument that I'm making.
Yeah, that's why you've been a great partner, and why I like talking with you when we do kind of bring it home to us individuals, or at or near retirement type of individuals or couples. It's all about being in diversified portfolios. There's places to quote unquote make money or not lose as much, or be safer than other parts, and that's why you do that. But so that's a good point. Couple other questions I have for you. So let's look at the real estate market right now. I'm getting a lot of questions on that. There's, home prices still are super high. Interest rates have been so high that people aren't buying homes because their mortgages are going to be so high. What is that going to look like? Is there something that's going to break there, or what do you see moving into next year just on that front? I'm just curious.
Yeah, so I think kind of like there's good and bad news on the housing market. The bad news is that things are kind of frozen in amber, and especially for like a new buyer, like a wanting to be a new homeowner, it's a pretty tough time for you, right? Because hey, there's no inventory on the market. You're paying 8% on your mortgage rate. I guess that's fallen recently by about 100 basis points. So now it's like 7, but
Yeah.
still historically pretty high. Uh, and obviously, prices are still high. They fell a little bit, but they rebounded fully in most places. So it's just a really tough time to be a new buyer. Now, if you're an existing homeowner, it's sort of a different story. If you're like worried about, and by the way, homes are people's biggest asset that they own,
Sure.
most people, right?
Yeah.
And so it's totally makes sense that people be concerned about their home values. The good news for existing homeowners is, well, listen, the only way that the price of your house is going to fall dramatically, like it did in 08, 09, and that's obviously what we're all concerned about, right? Is if two things happen, right? It's all about supply and demand. If the supply of homes goes up rapidly at the same time that demand falls, that's going to cause a reduction in prices. That's exactly what happened during 08, 09, right?
Sure.
All of a sudden, a bunch of bankruptcies occur, a bunch of foreclosures. People are walking away, giving their keys to the bank. The bank lists all these properties. There's a flood of supply on the market. At the same time, the entire financial system is on the verge of collapse, and no one can even get a mortgage, right? Today, hey, you can still get a mortgage. I know it's higher than anybody wants, but there's no supply coming online. And the reason why is everybody that owns a house has like a 3% mortgage rate or less, right? We all refinanced during the pandemic or
Yeah.
whatever else. And so, like, why would I go out and list my house to trade up or down? I'm not going
To
to get
go
any
from a
of my money.
2.5 or 3 to a 7. Yeah.
Exactly. And so, essentially, I think what you have people doing here is, yeah, they're kind of like stuck in their homes and they can't move up or down. But the good news is, hey, there's no supply coming on the market. At the same time, kind of demand remains constant. And so,
And it
yeah,
makes it
see
equal.
the
Yep.
huge decline in home prices. And if we were going to see it, I think we would have seen it to be honest, just because, listen, I mean, we saw mortgage rates go from 3% to 8%. And I think peak to trough, like the National Home Price Index has fell by 5%. And now they fully rebounded.
Interesting.
Now mortgage rates are at least like stabilized. They've fallen a little bit. I don't see where a big decline in prices would come from unless there's widespread defaults on mortgages. And the reality is everyone's up 40% on their equity, right? Not everybody, but generally speaking, everyone's, they've made money on their house. They have positive equity. So why walk away from it, give the keys to the bank? Overall, if there's not a flood of supply in the market, the price can't fall. So I think that's just kind of where we're at today.
Okay. No, that's good insight. All right. So as we kind of wrap up here, maybe two more questions. So we've talked, great insight again. Thank you for, we talked about 2023, kind of the crazy stock market, the Magnificent Seven, the bond market, kind of being muted and then doing pretty well here in the last couple months. Inflation, the Fed, all those things tying together, then moving into this year, possibly recession in 2024. But, the good old U.S. market and economy is pretty resilient and to remain diversified. But let me just ask you, what do you see? And I'll ask them at the same time. What do you see maybe as some good or exciting sectors? I know this isn't a recommendation to anybody, but in your opinion, what are some good sectors, whether that's in the bond market or equity market, that you see in 2024? And then maybe just give us a quick wrap up of, 2024 thoughts, and we'll end it there.
Yeah, so I think fixed income, obviously, my entire career, fixed income has been so boring. You haven't been able to earn any income. There's just no
time to shine now. Yeah.
Yeah, I guess it would reduce volatility, but it just wasn't interesting. Today, I think that's completely different, right? I mean, if you have all your money to sit in like a CD or money market fund, it makes sense to actually get into, I think fixed income investments where you can benefit from a decline in interest rates, because I do think that that's going to happen here in the year ahead. I wouldn't go really long in maturity, right? But 1 to 3 years makes sense to me. I think there's some good opportunities there. As far as sectors go, with investing, generally speaking, what I'm recommending to people is just lower volatility things, income paying stocks, companies with good balance sheets, things that are going to weather a lot of volatility without moving like crazy, right? So I'm an investor. I'm not a trader. I'm not going to ever be able to time, hey, I'm going to get out of the Magnificent Seven at the exact peak, and then I'm going to buy small cap stocks and ride them up, right? So I'm just trying to reduce the volatility of my portfolio by recommending things like dividend payers, value-oriented investments, things of this nature that do pretty well during volatile periods of time. And then the last thing I'd say is, what we call it, like the reindustrialization of America, the reshoring boom that's going on, right? We're bringing back a lot of factories, a lot of manufacturing to the United States. I don't think that this is a 1 to 2 year trend. I think it's going to happen for like a decade or more, because again, all the cheap labor abroad is drying up. And so there's a ton of, I even put like AI in this, right? It's just, how do we as America start producing more things for ourselves in a cost efficient way? Obviously, there's going to be a lot of infrastructure that gets built. There's going to be a lot of factories that get built, but it's also going to be the technology that helps drive that. So automation, AI, things of this nature. So I think, are there short-term challenges? Absolutely. But, medium to long-term, I'm very optimistic about America. I think a lot of the things that have happened post-pandemic have been in our favor. And I think as investors, the United States is the best place to be invested long-term. So that would be kind of my recommendation, broad sector-wise.
No, that's great. No, I think, to kind of end it, I think you hit it home with, we're investors, we're not traders. There's always something crazy going on in the market. We're just always trying to weather that as best as we can. There's a lot of things out there that can help us do that. But I think that's it for today. I really appreciate your time, all your knowledge and experience, and sharing that with us. Thanks, Bryce.
Absolutely, Ryan. It's so good seeing you again. And Merry Christmas. And hopefully we'll do it again next year.
High Point Capital Group is located at 1200 North Mayfair Road, Suite 300, Milwaukee, Wisconsin, 53226. Phone number 414-253-4600. Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA, SIPC. Osaic Wealth is separately owned in other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. Views expressed here should not be construed directly or indirectly as an offer to buy or sell any securities or services mentioned here. Investing is subject to risks, including loss of principal. Past performance is not a guarantee of future results. Indexes are unmanaged and investors are not able to invest directly into any index. Sector investing may involve a greater degree of risk than investments with broader diversification. However, there is no guarantee that a diversified portfolio alone will outperform a non-diversified portfolio in any given market environment. No investment strategy, such as asset allocation, can guarantee a profit or protect against loss in periods of declining values. Please note that individual situations can vary. Therefore, information should only be relied upon and coordinated with individual professional advice. Ryan Hitchcock believes the information presented here is accurate and was obtained from sources that are believed to be reliable. However, Ryan does not guarantee the accuracy or completeness of any information, and such information may be subject to change without notice from Ryan. Statements expressed by guests on this podcast are the views of those guests only and not of Ryan Hitchcock. Statements contained in this podcast may be statements of future expectations and other forward-looking statements that are based on Ryan Hitchcock's or guests' current views and assumptions and involve known and/or unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statements.